Hello, Diamond NestEgg members. I hope you're healthy and well. Welcome back to what has evolved into a 4-part members-only series on Boomer Candy ETFs, funds, and notes. As you may recall from parts 1 and 2, Boomer Candy investments are structured products that fall into 2 main categories. The first category are revenue-enhancing ETFs or mutual funds that promise higher returns. We've already covered these in depth in parts 1 and 2 of this members only series, and I've linked both of them below in case you want a refresher. The second category are risk-reducing products that promise to lower risk while still keeping some upside. This is what we'll be talking about in this member video, and the next one as well. Until recently, these have often been structured notes issued by financial institutions. These structured notes might promise you the potential for some, but not all, of the higher returns that are typically associated with an underlying investment in equities, such as a broad stock market index, while simultaneously also promising to limit your possible losses or even guarantee at least the return of your full initial investment in the worst case. And you might be thinking, sounds good, plenty of upside, limited or no downside. What's wrong with that? Well, you see, these structured notes are often only available for purchase via a financial advisor and usually not tradable, meaning they're not liquid. So you would need to wait until the note matures in order to get your money back. And even in outright emergencies, it might be hard to find a willing buyer for one of these notes at a price that you would find even semi-acceptable. The good news is that the market seems to have found a solution to this illiquidity problem in the form of structured protection ETFs. ETFs that work in principle like the structured notes here that we just described. You can keep some upside and also get protection against the downside. And because ETFs are listed on an exchange, these structured protection ETFs are also in principle liquid and freely tradable every day that the market is open, meaning you might be able to buy and or sell these risk-reducing ETFs any day on your own via a leading broker such as Fidelity, Schwab, Vanguard, or E-Trade. So that's what we'll be talking about today in part 3 of our Boomer Candy members only series. How do these risk-reducing structured protection ETFs work? And we'll be discussing a concrete example, the Calamos structured protection ETFs. These Calamos structured protection ETFs are relatively new, but have made enough of a splash on the market that many of you have asked us about them. It probably also helped that they were prominently mentioned in this original Wall Street Journal article on Boomer Candy investments, which is what inspired this 4-part members-only series in the first place. The Calamos structured protection ETFs are good examples to explain how these risk-reducing products work in principle, and what you should know before jumping into such an investment. As usual, here's our front video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, members. For those of you who may not be familiar with Calamos Investments, they are a privately held Chicago-based investment firm founded in 1977 by John Calamos Sr. At the time of this taping, they have 364 employees and 83 investment professionals, with about $40 billion in total assets under management. Calamos won the 2024 Newcomer ETF Firm of the Year award from With Intelligence, something that they're clearly very proud of, given how prominently this is displayed on their website. So let's take a look at some of these structured protection ETFs here on this list. And yes, these are exactly the ones that you guys emailed us about. As we can see from this list, Calamos launched their first structured protection ETF on May 1st, 2024, so not too long ago. And if we scroll down, we can also see that they have already published a schedule for future launches until June 2025. Calamos makes 3 promises about their structured protection ETFs, which some investors might find attractive. Let's start with their first promise, 100% capital protection, no downside risk over the 1-year outcome period. As it says, this means that they guarantee the return of your initial investment over the 1-year outcome period, even if markets were to go down. But this condition here, the 1-year outcome period, is important. let's go back to this list here from before to understand how exactly this guarantee works. Calamos' newest structured protection ETF, CPSN, launched just this month on November 1st, 2024 at a price per share of $25.03. This initial NAV column basically shows you the price per share of each of these ETFs on their launch date here. And this current NAV column shows you essentially the current price per share of each of these ETFs at this date and time up here. So going back to this first promise of 100% capital protection, no downside risk over the 1-year outcome period. For CPSN, the 1-year outcome period started on November 1st, 2024, the launch date, and will end on October 31st, 2025, 1 year after the launch date. And the guarantee means that if you had purchased CPSN at this price per share of $25.03 on its launch date of November 1st, 2024, when the 1-year outcome period started, and you hold it until the end of the 1-year outcome period on October 31st, 2025, Calamos guarantees you that on October 31st, 2025, you will get back at least this $25.03 per share that you initially invested on November 1st, 2024. This promise is before cost, by the way, but more about that later. So, to repeat it, for CPSN, the 1-year outcome period where there is 100% capital protection and no downside risk always assumes that you purchased the fund on November 1st, 2024, the launch date, and that you hold it until October 31st, 2025, 1 year later. So far, so good. But remember, we said that part of the charm of these structured protection ETFs is that you can buy and sell them in principle every single day that the market is open. And you can, but if you do buy or sell your ETF on the market, you will have to accept the then prevailing market prices, meaning that if you were to buy CPSN at the time of this taping and pay this current price per share of $25.21, this 100% capital protection still only guarantees that you would get back the initial launch price per share from November 1st, 2024 of $25.03, not the $25.21 that you actually paid. So your initial investment would not be fully protected in this case. And it's also not a full year for you, as the guarantee will kick in on October 31st, 2025, 1 year after the initial product launch, regardless of when you bought your shares. And that's why this outcome period here says 359 days. At the time of this taping, there are 359 days left until the end of the outcome period, which for CPSN is again October 31st, 2025. Remember this point. We will be coming back to it later on, as well as the information in the rest of these columns here. For now, though, let's move on to the second promise that Calamos makes about their structured protection ETFs, which some investors may find attractive. Defined upside participation, exposure to the S&P 500, Nasdaq 100, or Russell 2000 to a cap, meaning that each of Calamos' structured ETFs allows you to participate in the upside of an underlying stock market index up to a predefined cap. Again, going back to this list from before, this reference asset indicates the underlying stock market index for each of these ETFs. SPY is State Street's S&P 500 ETF. QQQ is Invesco's Nasdaq 100 ETF. And IWM is iShares Russell 2000 ETF. It's up to you to choose what you prefer, but so far we count 6 already launched ETFs based on the S&P 500, but only 2 each on the Nasdaq 100 and the Russell 2000. And yes, there is the mention of a cap here as expected, but more about that later as well. Let's first wrap up the third promise that Calamos makes about their structured protection ETFs, which is tax alpha, seeks tax-deferred growth inside the tax-efficient ETF wrapper. Sounds nice and fancy, if a bit vague, but what this essentially means is that you get no dividends, no cash distributions along the way. It seems that Calamos' structured protection ETFs are designed to generate long-term capital gains, which may be taxed at lower rates if you hold the investment for more than 1 year. This tax treatment is different from short-term capital gains and dividends, which would be taxed at your generally higher full personal income tax rates. More on the no dividends bit shortly as well. So, to draw an initial conclusion, based on our analysis, it does seem that Calamos is offering structured protection ETFs that can deliver on all three of these promises. Their structured protection ETFs do provide downside protection for the initial capital that you put in, assuming that you buy on the first day that the ETF is launched and hold until the end of the 1-year outcome period. They also give you access to the underlying performance of a stock market index up to a certain cap, and they don't pay dividends. So if you hold your ETF shares long enough, you may benefit from the lower capital gains tax rates. Of course, the detailed prospectus also carries the usual warnings about not being able to meet their promises under unforeseen and dramatic circumstances that are beyond their control, such as war, complete market meltdown, natural disasters, and so on. These caveats are pretty standard in the industry though, so no red flags here necessarily. So far so good. But when you dig below the surface, you will find that these structured protection ETFs are very complex. And there's a bit more to the story. So let's make sure you understand the details of how they work in order to decide for yourself whether it's worth putting your hard-earned dollars into any of them. The first thing you should know is that Calamos' structured protection ETFs are options-based investment products, meaning they use only options and have no direct ownership of any underlying securities. And specifically, they buy and sell European-style options, meaning options that can only be exercised at expiration. This is different from American-style options, which can be exercised at any time prior to expiration. And this construct with European-style options that can only be exercised when they expire after 1 year explains why the 1-year defined outcome period is so important for these structured protection ETFs. If we take CPSN as an example, this means that on November 1st, 2024, CPSN purchased and sold European-style options on SPY, which again is State Street's S&P 500 ETF. All those options have an expiration date 1 year from the launch date on October 31st, 2025, and allow CPSN on a combined basis to meet each of these promises here. So let's talk about the options they buy and sell in order to provide this 100% capital guarantee, this defined upside participation, as well as this tax alpha. And as we normally do at Diamond NestEgg when things get complicated, let's walk through an example. Let's assume that Calamos is launching a new structured protection ETF that tracks the S&P 500 index on January 1st, 2025 at $100 per share, and you buy 1 share of this new ETF on January 1st, 2025 at $100 per share. And yes, I know the market is not open on January 1st for trading, but as this is a hypothetical example anyway, let's pretend that it is to make things easier. So, Calamos' new structured ETF now has $100 of your money invested into it. Here are the options that Calamos would buy and sell on January 1st, 2025 with the $100 you invest. First, Calamos would buy what they call the participation layer. This is essentially the option that gives you the exposure to the S&P 500's performance. You can think of it as your main investment into the S&P 500, almost like owning the stocks of the S&P 500, just in the form of an option. So, $98 of the $100 that you invested into the ETF would go into this participation layer, which is technically a 1-year European-style call option on the S&P 500. And as I just said, this allows you to participate in the S&P 500's ups and downs over the 1-year outcome period, but excluding dividends. Second, they would buy this capital protection layer. This is the option that protects your initial investment. That's the guarantee on your principal. The remaining $2 of the $100 that you invested, plus $2 borrowed from Calamos, so $4 in total, would go into this capital protection layer, which is technically a 1-year European-style put option on the S&P 500 with an exercise price that is set exactly at the level of the principal guarantee. This ensures that after 1 year, at the end of the 1-year outcome period, you would get back 100% of your initial investment, even if the S&P 500 index is down, minus any fees that the ETF would charge. So at this point, the $100 that you've invested with Calamos has been spent. $98 of it here to buy this participation layer, your actual investment if you like, and $2 of it here to buy this capital protection layer, the guarantee of your principal. In addition, Calamos had to lend you $2, so to speak, to fund this capital protection layer because it costs $4 in total, which is where this third upside participation layer comes in, the cap on the upside of your investment. Because Calamos is a business and not keen on subsidizing your capital guarantee with their own money, Calamos needs to earn back the $2 they lent you to buy the capital protection layer here. And because they don't want to charge you an extra $2, they sell a call option on the market to get back their $2. In essence, they give another investor the right to buy you out of your underlying investment in the S&P 500 when and if the S&P reaches a certain level. To do this, technically, they sell a 1-year European-style call option on the S&P 500 for a certain level or strike price above where it is today. And this is how this works. By selling this call option, we earn $2, which are ours to keep in any case, and will be used to pay back the hypothetical loan from Calamos to the ETF. Now, as to the option itself, if the S&P 500 remains below this strike price, this call option expires without being exercised. All the gains or losses below the cap are yours. But if the S&P 500 reaches or exceeds this strike price, the predefined level of the cap, the buyer of this call option will exercise the option and will buy your underlying investment in the S&P 500 from you for the predefined price. And that's what caps your upside here in the S&P 500 within a structured protection ETF. In other words, in such a structured protection ETF, your upside here that you could have earned on the S&P 500 is capped because Calamos basically has to sell it away to earn back the $2 that they lent you here to buy the capital protection layer that guarantees the return of the initial principal 1 year after the launch date. And generally speaking, the lower this strike price is here, the higher the price that Calamos will get from selling this call option. Because the more likely it is that the S&P 500 might cross this certain level, and the more upside Calamos is giving up on your behalf. And the higher the strike price is here, the lower the price that Calamos will get from selling this call option, because the less likely it is that the S&P 500 might cross it, and the less upside Calamos is giving up. As I showed you earlier, Calamos' goal is to sell this call option here exactly at the price that allows them to earn back what they lent you to fund this capital protection layer. And because these exact dollar amounts will only be known on the date that the structured protection ETF is launched, this means that this exact strike price, this exact cap level, will also only be known on the date that the structured protection ETF is launched, and not before then. And that's why before a structured protection ETF's actual launch date, you will get a range for this cap level. Here is a screenshot that we took on October 29th, 2024, a few days before CPSN was scheduled to launch on November 1st, 2024. And as we just discussed, you can see that the cap was given as a range here, 6.39% to 7.01% on a gross basis, meaning before fees. And here is the cap range on a net basis, meaning after fees. But more on the fees in part 4 of our Boomer Candy members only series. Let's talk about the cap range on a gross basis, before fees, for the time being to keep things simple. So, when CPSN finally launched on November 1st, 2024, the actual starting or initial cap rate on a gross basis for CPSN was 7.43%. Slightly better than what Calamos had projected here. So a bit of a favorable tailwind for all investors in CPSN, as they get to keep a bit more of the potential upside of the S&P 500. To calculate the maximum amount that you would earn from CPSN after the 1-year outcome period, this 365 days here, you would take the actual price per share of CPSN on its launch date, this $25.03 here, and multiply it by the starting cap rate on a gross basis for CPSN on its launch date, this 7.43% here, giving you a possible maximum earnings amount per share on October 31st, 2025 of $1.86 on a gross basis. What this means is that if you had bought one share of CPSN on its launch date of November 1st, 2024, and you hold it over the 1-year outcome period, this 365 days here, until October 31st, 2025, on October 31st, 2025, your share of CPSN would be worth a minimum of $25.03. The actual price per share you paid on November 1st, 2024 here, which was 100% protected on a gross basis on the launch date. But your one share of CPSN would also never be worth more than $26.89. The actual price per share you paid on November 1st, 2024 here, plus the possible maximum earnings amount per share on October 31st, 2025 of $1.86 here on a gross basis. That's the effect of the cap. What this also means is that the price per share of CPSN should never really go above $26.89 on a sustainable basis over the 1-year outcome period. And if it ever did, it would pull back to the cap level as the end of the 1-year outcome period got closer. But, and that's important to keep in mind, these numbers only work if you buy CPSN on its launch date, November 1st, 2024, and hold it until the 1-year outcome period ends, October 31st, 2025. If you buy after the launch date of November 1st, 2024, and the price per share of CPSN is different from what's shown here, the amount of your actual principal investment that is protected also changes. You cannot just apply the starting cap rate of 7.43% and this protection level of 100% to your purchase price. Let me show you what we mean. Here, we'll assume that you bought CPSN on the launch date, November 1st, 2024. Here's your purchase price per share. This is the cap at the time of purchase on a gross basis. Here is the protection level at the time of purchase on a gross basis. And here is the outcome period. All of the numbers shown here correspond to these numbers here from before. So, if you had bought CPSN on November 1st, 2024, the possible maximum earnings amount per share over the outcome period of 365 days here would be $1.86. Again, that's these two numbers multiplied together, meaning that the maximum price per share for you on October 31st, 2025, at the end of the outcome period, at the end of 365 days, would be $26.89. And again, that's these two numbers added together. This protection level at the time of purchase on a gross basis of 100% means that the minimum price per share for you on October 31st, 2025, at the end of the outcome period, at the end of the 365 days, would be $25.03. That's these two numbers multiplied together. And as promised, corresponds to a 100% protection of your initial principal in this case. Now, if you had purchased CPSN after the launch date, just a few days later on November 6th, 2024, this would have been your purchase price per share, your cap at the time of purchase on a gross basis, the protection level at the time of purchase on a gross basis, and the outcome period. Following the same logic as we just did here, this means that the possible maximum price appreciation per share over the outcome period of 359 days would be $1.69 and not $1.86. And that's because at the end of the 1-year outcome period on October 31st, 2025, your maximum share price, the price at which you're capped via the call option, will be $26.89, the same as for those who bought directly at launch. Mathematically, that's these two numbers multiplied together with a bit of rounding. This protection level at the time of purchase on a gross basis of 99.37% means that the minimum price per share for you on October 31st, 2025, at the end of the outcome period, at the end of the 359 days in this case, would be $25.03. Again, the same as if you had bought on launch day. Mathematically, that's these two numbers multiplied together, rounded down. So in this instance, your initial investment here of $25.21 is not 100% protected on the downside because the put option from day one only protects $25.03. There is a chance that you could get back a little bit less at the end of the outcome period than you had originally put into CPSN. In other words, no matter what your purchase price per share of CPSN is after the launch date here, the price per share on October 31st, 2025 will never be higher than this price here or lower than this price here. Now you know what I mean when I said early on in this video that Calamos' structured protection ETFs are quite complicated creatures. Hopefully, we've managed to take some of the complexity out of this for you. If you have any questions or comments at this point, do drop them below and I will try to cover them in our next live member Q&A or in part 4, the final part of our 4-part members only series on Boomer Candy ETFs, funds, and notes, which should be out in a few days' time. In part 4, I'll be answering these two questions. First, what are the 5 important factors to consider before diving into Calamos' structured protection ETFs? And second, would we buy them for our own portfolio? All right, super savers, as usual, I hope you enjoyed part 3 of our 4-part Boomer Candy members only series. And do continue to spread the word on our member community with the fixed income fans you care about. We appreciate you and see you again very soon with more brand new wealth building content for your financial journey.